All right, people, welcome on. Part 2 is going out now, so I want to make sure that you guys have this going on. And then after, we'll take it from there. All right, so now we're in part 2. I hope you guys are doing all right. Now, obviously, I think I need to rename this part 2. Okay, I have. Let's see what happens. I'm going to start live in a moment. I give everyone a couple of minutes. I know that you're listening from different parts of the world, so I wanted to make sure I take the time to go through what we have going on here. So jump on as you're coming on. Just put this on. All right, welcome guys as you're coming on. I want to start, I think I'll start in about 1 or 2 minutes. So share with your friends, let people know what's going on. And I'm gonna start, okay? All right, so welcome on board. Now with this part 2, guys, we're gonna go take a step further into looking at price action and what the market has to offer. So I want to make sure that I see all of you guys on. Okay, I'll wait a little bit more. Then we can go from here and see. See what happens there. All right, 1 more minute and then I'm going to begin. So just share with people, give everyone a chance, you know, to see what happens today. Yeah, I am excited though to teach. I think this has been a great series so far. And even for some of you who are going to watch this, you know, before the live or after the live, I should say, you know, I think, you know, it's really exciting to have the opportunity to teach. And I really want to spend the time to really go through the things that will help you to be the trader that, you know, I know that you all aspire to be. Okay. So without further ado, let me start this session officially. And let's have a recap. Now, when it comes to today's session, and I'm going to let me just put something up here on the side here. Let's put this here. I'm going to put this here. Price, delivery. Let's put this here. Institutional. Price action. Part 2. All right, so this is part 2, just to make sure there's no confusion here. Now, in today's session, the title of this session is Price Engine. So yesterday we looked at the price delivery mechanisms that price comes through the market. And now the actual price itself, we know it comes from the interbank network. And, you know, if we go through the structures of what we went through yesterday, talks about a lot of things. Now I have it on my chart here, interbank network, okay, the price, and then the price is provided to you. Now, of course, there's some lines here that need to go in here. So if I put this along here, this is the conveyor belt, if you want to put it this way. So the price comes from the interbank network. Now, things like swap, the reason why we get charged swap is because of the interbank network and how the banking system works. we have things called LIBOR, which is the interbank rate or the overnight interest rate for borrowing. If a bank borrows a certain amount of money from another bank, how much is the interest rate overnight for holding it? Okay, so the 1 day overnight interest rate. Things like that, like LIBOR figures, do have a preface within the market of why spread might be positive, spread might be, I mean, not even positive, swap might be positive, or swap might be negative on your account, commission prices sometimes, and things of that nature. So with the conveyor belt here of how prices deliver, so the price is delivered through the interbank network, is worked out with predefined variables within different banks, and they come together to form the interbank network. Now, things like LIBOR rates are calculated with a specific group of bank, which is like the AAA listed banks. We're going to put it that way. And then moving forward, we have the brokerage, which is to connect to liquidity providers, okay? And then through the liquidity providers here. Now, if you want to, I'm going to do it this way. I'm going to change this slightly so that it makes a little bit more sense for you guys, because there is one step between interbank and brokerage, which is the liquidity providers. So if you guys have seen stuff like the LD4, or you've seen servers like that on your brokerage and you're wonder what that is. Well, that comes from the interbank network through liquidity providers, okay, which work along with exchanges to obviously make money for themselves, but of course to produce, let's put this here. And let's put this here. So I'm going to put a brokerage here. All right. And then after, I'm going to put this out over here. All right. So we've got brokerage, interbank network. And between that, we have one more final part, which is going to be liquidity providers. So I'm going to put this here and put liquidity providers. So really, in principle, the price of an asset or the price of anything to do with financial markets gets passed down at least about 2 to 3 levels before it reaches you. Okay. I just want you to know that the price of Forex that you do see on the charts is never going to be the premium price, even down to the broker level. And I'm going to show you in a moment why. Okay. Now, if you can understand how price is and what price is and who it is, if you want to put it that way, in a sense, okay, then it will help you to understand where it comes from and where it's going to next, okay? And the whole business of how the market even works. Because I think that when I speak with, traders sometimes, I think there's still a bit of an understanding that, even though people may know about smart money concepts, which is coined by ICT, for example, or that the banks are in control of the market, the understanding of how price is delivered into the market is still a bit, more vague. When you ask the question, how does price come into the market? Where does it come from? Okay. So I'm going to just drag this here as of such. All right. And then we're going to go over here and I'm going to keep the latency speed here and so that you can see what I'm talking about. So let's put this over here. Now my diagrams, I've decided to do everything on the charts instead of bringing up PowerPoints. I didn't want to bore you guys with PowerPoints, even though there might be a need for it. I just wanted to keep it minimal and just focus on the candlesticks. Everything is in the candlesticks. I'm creating all the teachings from here. So it might be a little bit slower when I put this stuff on. And then after, just stick with me so that I can deliver this to you guys. All right. So we've got price here. I'm going to put all the price in blue so that, purple, and all the writing in blue so that you guys can be with me when I'm talking. All right. So here we go. So we've got the first one, interbank network price. Liquidity providers give a price. Then brokerage, they give a price. And then the price comes to you. All right. So the price itself gets, and this is a key here. All right. In order for, if you're a business person and you get something at a discount, the whole reason why business works is because one of the biggest ways business works anyway is that you are able, okay, to get the price of something at a discount and sell it for more, which is a premium, okay? Premium. So when it comes to price action and you're looking at what the price is actually doing, okay, even before we go to calculating, you know, where price is going next and all of these different things, the key is to understand this mechanism here. All right. Again, I told you that when it comes to price action and how price works and price delivery, one of the most important things for you to understand always is going to be how price is delivered over from one place to another, which is from the beginning of the market all the way until you get to yourself. Okay. Now, when it comes to price delivery mechanism, so let's start this again. So we have the interbank network, which is to even get access to the interbank network or to be involved in the interbank network and be a bank that provides a price. All right. It is a privilege. Okay. So by default, this is a small group of people. Okay. Then we have the next group of people, which is liquidity providers, which is slightly larger, but still a small group of people. All right. And these people control 90% of what goes on with price action. Okay. Then we have the brokerages, which are much more abundant than liquidity providers and interbank network. The interbank network, because, you know, brokerages are more widespread business. There are hundreds of brokers, even probably thousands of brokers today, but there are not there's not thousands of liquidity providers. When it comes to financial markets, there's a lot less and much larger groups of people. Okay, so money is located a lot more concentrated in a small pockets of areas around the world. Okay, next, of course, is to you. Now, one of the key things I want you to understand is that as a business model, how do liquidity providers make money? Interbank network people make money. How do brokerages make money? Well, the key is this one word here, or this sentence here, is to get something at a discount and sell it for more, which is at a premium. Okay. Now you have to understand when we're talking about the currency market, let's say we have Euro USD. I'll use Euro USD. All right. And let's say the interbank market, after rounding out the figure, the agreed kind of interbank network price, depending on who's providing you the liquidity, is, let's say that the euro, I'm just going to make it easy, is 1,500. Okay. So remember, because we're dealing with pips here, for most brokers, it's going to be 5 significant figures, or 5 decimal places after the 1. Okay. So this is the interbank network price. Okay. Stick with me here. Now, in order for the banks or whoever sells the currency or provides currency to liquidity providers, we're then going to produce it, give it over to the market and different places. Okay. In this food chain, if you want to call this the price food chain, when it gets to the liquidity providers, what's going to happen? So the interbank network, what they will do is that they may actually have the currency at a rate of 1.400, and they're going to sell it. Okay. So I put here original price at, let's say, 400. Oh, let's just make it a little bit more realistic, 450. Okay. So let's just say 5 pips more is the actual original price. Okay. So I'm going to put original price. So the original price for Euro USD is 1.00450. Okay. And that comes from the interbank network. Now, on this conveyor belt, the interbank network people, if they sell this currency at this price, so let's say, for example, the liquidity providers, they need dollars or something like that, and 1 euro equals to 1.00450 US dollars. Okay. Then what they're going to do is that they're going to sell the price with a little bit on top so that they can make a difference. They can make the difference between the original price that they have it for and to what liquidity providers are providing it for. Now, what gives the interbank network, the best way I can put it, is advantage over the liquidity providers is their source, because of course the interbank network gets their currency directly from central bank coffers. Okay, and to get access to those kind of premium places of currency where currency is derived from is near to nothing possible. You really need to be in the upper echelon of society to do so. So by default, money is already the main large amounts of money are streamed through very small pockets of organizations or institutions. Okay, and this is where you get the term about institutional trading. So they sell it to the liquidity providers and they add, let's say, let's make it a bit more realistic here. They add another 10 pips on. So the original price they've got it for is 450. They sell it over. Okay. They sell it at, all right, to these people here. So now these people here, when they get over to the brokerages now, they provide a price to them. The liquidity providers provide it, let's say, to the exchanges and the brokerages, all right, for another price. And they say, okay, we're going to make Euro USD 750. Okay. Oh, 5. Say 650 here. So now for them to sell, now in this example, I'm just using hundreds. Okay. I think what I'll do, I'll make it a little bit more mathematically sound. I'll just call this 850 for now. All right. So these numbers are just for an example. Is the pip difference is a lot more less than what I've said. But again, the liquidity providers are going to sell Euro USD over to brokerages or give them a price feed, which is a few pips above. Okay. So in this case, this is quite a few pips. This is 30 pips. They've given them 30 pips on top. It's actually quite a realistic example. Now, the brokerages now need to price the price to you. Now, they're going to pass the price to you, okay, at also a premium, because brokerages make money in 2 ways, okay? And the 2 ways they make money, well, there's actually 4, but I'll teach on 2. 2 are more secretive, but 2 are more obvious, okay? The first one they make is the obvious one, which is commission per trade. Okay, that's one way they make money. So I'll put this in blue here. Second way that they make money is from the spread, okay? Now, even with zero spread accounts, there can be zero spread a few times here and that, which means that spread is the difference between the actual price or the asking price and the bid price. Okay, there's a difference between the two. So if I go over here to, let's go at 2 and say spread. Okay, difference between ask and bid prices. Okay. Now, if you notice when you open up a brokerage account, they give you different options. Now, the most popular options currently that we have, today is to have an account which has a spread of zero spread, or they'll call them zero spread or ultra low spread accounts. What they're doing is that the ask and the bid prices are at a small, or the asking price or the actual price that you trade on is at a much smaller premium than you usually would have on a normal account. All right. And usually the compensation for that is that you get charged more commission per trade. So every time you place a trade in the market, depending per lot size, let's say for one lot, you might be charged, let's say $10. Okay, which is like a kind of normal industry standard, about $10 per lot, maybe something like that per your trade. Okay, sometimes more, sometimes less. Now, depending on what account you have, these two on the front end kind of situation in terms of how the brokers make money from you are more apparent. If you have a normal spread account or you have a spread-based account, then your commission will be a lot lower, or sometimes even zero, and they just charge you spread. Or if you have an ultra low or zero spread account, then you have very low spread, which is good for stuff like if you're a scalper or whatever, but then your commission will be a lot higher. Okay. This is the kind of interchangeable situation that happens with brokerages. Now, they also need to give you a price because they're connecting you to the market, because as you need a lot of money, if you wanted to access the market for yourselves without an intermediary, it's going to cost you a hell of a lot of money to connect yourself up to a liquidity provider to give you a feed just for you. Okay. So brokerages are a very good middleman businesses because it allows millions of people to have access to the market where they probably wouldn't be able to have access to the market as intermediaries, and through that brokerage account situation, you're able to access the markets for yourself, take trades and etc. So it's a really beautiful infrastructure that they've made. Now, for you as the trader, the price you'll probably get that the brokerage doesn't get will be a bit more. So one of the things that brokerages will do, not as apparent as the liquidity providers and the interbank network, is maybe give you a price which is not exactly too far from what they've got, but maybe let's say maybe just 4 pips above. So they'll give you 0.90. So they'll give you 1.100890. Okay, by them doing that, the difference between what they actually get the price for and what they're giving to you in the market, that difference, they make money from that too. So every time you enter a trade, even if the market price is 50, which has already been premiumed twice over, they make a little bit of money on the difference between the actual price that they've got from the liquidity provider, after they're purchasing whatever they do, and then the actual price you get. Okay. And this is where you look at the price and make your decision. So every time you take a trade, every trade you take has immediately made money from the brokerage, which is fantastic. And of course, the second way they make money is going to be the commission. So I hope you take his picture into mind as to how price works. So now that we know this, okay, and with the liquidity and how it works, the source of where liquidity comes from, which is from these banks, interbank network, governmental levels of money, and liquidity providers, these are the people, and I'm going to put this here, that we need to be focused on to understand how do these people think. Because evidently, without having to go into too much detail about the mathematics of it, these people here have the liquidity to cause the markets and the rest of the trading financial instruments in general, they have the ability to cause the price to move, okay, because they provide the liquidity that causes the price to even move really most of the time, okay? So now the understanding has to be, okay, if these people have control over the market, what is their main objective? Their main objective is what I'm teaching today, is to, again, get something at a discount and sell it at a premium. Because remember, in every level here, what are they doing? They're having they have a cheaper price, which will be considered a discount in a sense, from the market price. So by the difference in the original price and then the next price over, every single time this asset is sold over, you can see that there's a bit more pips, there's a little bit more pips added on, and that little difference is where money is made. Now, when it comes to the financial markets, apart from just offering liquidity, the other thing that is also important to pay attention to is how does liquidity move around? So let's look at this. So I'm going to define a few things so that you can understand the price engines of the market. So the engine that controls the price can be quantified. Now, the market order book would be the best place for you to find out exactly how many orders are going in and out of the market. Now, I guess for a business perspective from these guys, it's very difficult for you to get access to that market order book. If you try to, for example, if I right click here and I went to market depth, which is basically the market order book, you'll be able to see orders coming in and out on both sides. So you can see on the blue side will be the buys, the red will be the sell. And this is what a very simple market order book looks like. It shows you on each level how much liquidity is on each level. Now, when I first started trading, you would see, big lot sizes come in. So you see 200 lots on one side and some on the other. Now, I guess some traders became a bit smarter and realized that if I see that there's a lot of people selling, or there's more lot size, let's say at this price point here, 623, if there's 500 lots going short and there's 100 lot going long, there's more selling liquidity in terms of lot size than buying liquidity. So I should be selling. And that was one of the ways that people were using it to be able to create, structure here. Okay, so when it comes to price delivery mechanisms, this is one of the things that are important. The market order book for Forex is very, very secretive and hidden. Okay, it's very difficult for you to get access to it. Maybe Pound USD you could do, but for other things you can't. So the question that is now is, okay, so how would I quantify what price is doing without having a market order book? Well, thank you for asking the question. I'm going to show you. So there are different levels to how data operates, and I'm going to show you just 2 levels for today. And then after, we can look at level of how to look for price action. So we have level 1 data, okay? Now, what's the characteristics of level 1 data? Level 1 data, to save you trying to the guessing game, is going to be chart data, okay? represented in graphical form. So the data that most of us base our trading on, okay, is level 1 data. Now, for things like stocks, you can actually look at level 2 data. There's a lot more transparency there. You can actually look at the market order book and see what's going on for almost any sort of asset within the stock market. But for Forex, it's not. So with Forex, the reason why the failure rate is so high is because that lack of transparency doesn't mean that Forex isn't a great industry at all, but it's just that the approach of analysis relies a lot more on technical analysis. That's why to be a fundamental analyst in Forex only would always be a dangerous thing if you're not institutional, because first of all, the way that price moves day to day, for you to actually take a trade, the wicks and the bodies don't necessarily move because of fundamental news. They move into position for fundamental news to be the final leg, usually to trigger something to happen. So what you do need to do is that for Forex, for you to be successful, you need to be a very good technical analyst. Okay, if you hear videos and on YouTube that you don't really need technical analysis to really make it, or you don't need much, it's all exaggerative lies, because in order for you to understand how to work with these people who have access to a lot more depths of data, not to mention that I didn't speak about latency much, but the speed of access they have are in the milliseconds compared to us. By the time price is quoted in this area, okay, they have at least a few milliseconds or quite a few milliseconds of advantage against the trader. So that edge of not just information, but speed of information puts us at a disadvantage. So the only way you can really work with these guys, like I always teach my Wealth Group Academy students, is kind of like in Nemo, the fish, the small fish that swim with the big sharks. The fish is actually a predator towards those fish, and the fish are actually prey. But the reason why they have a great symbiotic relationship is because what they do is when the fish or the shark is going for the big kills, the little fish that are swimming underneath the shark unknowingly go in and try to get some food for themselves. Even though the shark tries to chase them off when they, eat his catch, they still get something. And this is the same way. Unfortunately, it doesn't mean it's bad, but it's the truth that you're a small fish. You're not a bank, you're not an institution by yourself or even as a group of people. So these big fish, or the big whales, that's what is usually called in crypto, the whales of the financial markets or assets that we're talking about, have the liquidity, have the ability to kill, prey, and eat. So what we want to do is learn how to think like them, so that when they're killing their fish and making billions, we can make a couple of millions or a couple 100,000 or 10,000 or even $100, whatever it is. So this is how I want you to be thinking. So level 1 data is chart data represented in graphical form. Okay. The next level of data that we're looking at is level 2 data. And the level 2 data is which we will say separates the men from the boys. And this is the market order book data. Okay. So when I talked about price delivery mechanisms yesterday, if I was to go over to this side here to look at what we're talking about, so level 2 data, all right, this is market order book data here. So if I put this over here, market order book data. Okay. Now, what is market order book data? Well, the reason why the price moves up and down, okay, aside from what we're going to go for in the bare bones of how a market order book works, is it manages buy and sell orders of all types, okay, and amounts, to make it very simple. Now, of course, we can be more complex with it, but this is what market order book data does. It manages buy and sell orders and make sure it balances out. Remember, I told you in a market, all right, you need someone, in order for someone to be selling or for you to be buying, someone needs to be selling, okay? If you go to a market and you want to buy oranges, someone needs to sell you the oranges for you to buy it. And it's the same thing when it comes to trading or even with stocks. I think stocks is probably an easier example to use, in the sense that with stocks, if someone has $1,000 worth of a stock, okay, let's say they have 1,000 units for $1,000. If they want to sell those stocks back into the market at, let's say, $3, then somebody also needs to be buying the stock for $3, because they need to provide the liquidity to cover that position. Okay. So the market order, when that transaction is happening, the infrastructure responsible for that is the market order book, which is electronic, okay, or automated. So this market order book here is where the orders are managed. Now, even though institutional money has the money that drives the market, they also have to go through a market order book and put their entries in, or their buys in, or their sells in, okay, because they're also competing in groups to get against each other or for each other to make money together, or one makes money against another, and etc. So this is really, when it comes to how price action works, what you see on the charts. So when the big moves are happening, it means the big boys are having a tussle, if you want to put it that way. And so your idea of what you want to do as a trader is to figure out when that's happening. Okay, that's the key. So moving forward from now, you understand this concept, then you can understand what to do. Now, with level 2 data and level 3, there are, let me put this here, and I'll delete this for now. With level 2 data anyway, the relationship between them is actually this way. Now, I've drawn an arrow pointing the other way, but reality is it goes in levels upwards. So if you're to think of it kind of like a pyramid, okay, or a food chain, all right, the bottom of the food chain actually starts over here, okay, starts over here. So level 2 actually goes to level 1, not level 1 to level 2, because what's actually happening here is that when orders are passed through, so orders sent, okay, this is the direction. When it gets to the level 1 chart, which is where retail traders usually produce their orders, and other people in the market after they're doing their analysis, I'm going to put this here, orders are, I'm going to put this here, sent back, okay? So you've got this kind of two-way system. So orders, when they're sent into the market, okay, it goes to the market order book, and then a response is given back, okay? So they've got this two-way system of orders going on all the time, 24/7, 5 days a week for Forex. In reality, for the foreign exchange market itself is 24/7, because you have to remember, guys, when it comes to liquidity providers and brokerages, it doesn't just mean a Forex broker where you can trade. You know, foreign exchange itself, currencies, businesses, large businesses, Apple, Google, Microsoft are always dealing in multiple currencies quite often. Why? Because they do business in other countries. You know, if someone wants to buy, you know, a $1 million or $10 million load of, I don't know, Chinese yen goods, you know, they might have to convert their dollars to yen. They may not have to, but if they need to do a big conversion like that, then they're going to need somewhere they can convert that physical cash or digital cash to. Okay, so all of those levels of foreign exchange, I want you to kind of broaden your mind. Don't just think about Forex in terms of just trading. Think about foreign exchange as an industry, what it means. When you go on holiday, you need to convert your money from one currency to another. Okay, and when you do, if you've noticed, I've done this myself as a Forex trader, especially, I check the charts on my phone to see what the price is that the broker is giving. And when every single time without fail, when I go to the post office, which I'm in the UK, so for those of you around the world, your mailing services where you can exchange money, or just a place where money exchange can happen physically, you always notice that there's a premium on the price compared to the market, or even wherever you quote on the internet, there's always a premium to that. And that premium is where the people who are giving you the currency make money too. So if you give them, let's say £100, maybe on the market, £100 equals to 115 euros, let's just say. But you go over to the exchange place, and when you give them £100, they give you 107 euros. So that £8 difference is what they make per transaction. And that's how they make that money. That's also a premium. Okay, so that's another advantage of, you know, being in that position. You can make money from that. So now that you understand this, what happens when we're looking at the charts now, when most of the time, and this is what happened to me when I was trading, my main focus was on level 1 data. I was looking at candlesticks. In my early days, I was actually looking at line charts when I was trading binary options. Then I moved over to candlesticks. Some people use the bars instead to trade with, which is not really too much my fancy because it just doesn't look so nice. But anyway, I prefer to use candlesticks. I think they're the most graphically pleasing to look at. Now, when it comes to this mechanism here that we're looking at, when the price is coming in or orders are coming into the market and they're being sent in, the market order book has to take into consideration a few things. It needs to take into consideration if 10 people are buying, then there needs to be matching orders for 10 people selling, because somebody's coming into the market, someone's coming out. So it needs to make sure it's balanced. So when there's something like an imbalance and price is still moving along, the market order book will have to find a way and wait for the nearest opportunity it can to rebalance the market. Okay, and this is where terms like market imbalances or liquidity voids, which you hear later on, come from. Okay, so when the orders are sent in and then the orders come back out, this is what happens for it to be able to do such a thing. Okay, then now when we look at the charts, the only thing we have access to at the moment in Forex as retail traders is chart data. You notice that anyone who's in the industry doesn't actually have a brokerage account and they're on the insiders traders list, because the things they know and they have access to, they could definitely have an advantage. And there's been historical situations of insider trading and people have got into big trouble from the smallest to the greatest for insider trading. So that disadvantage of knowledge needs to be compensated somehow so that you can have a way to also have access to the market. And how do we do this? Well, the thing is, you need to understand how does liquidity work from this point of view. So the linear regression models that we're going to look at, and then you need to transmute that into chart data in graphical form to figure out when interbanks or liquidity providers are doing certain things. All right, so now that you know this, let's go through the first price engine. Now, price engines, or what causes the market to move from level to data, and what we're going to focus on is supply and demand. Okay, so we're going to look at supply and demand. Now, supply and demand is an important concept. And when I first started trading, what I call supply and demand today, I used to call support and resistance, which is not really the correct term at all. Okay. Now, as I've grown and matured, I understand that what people are calling support and resistance is supply and demand, and also other algorithmic processes, which is not necessary to go through right now. The focus is on the price engines of supply and demand. So what is supply and demand? Well, the final thing is when we look at the market order book, remember I said to you, if I give you an example here. So for an example, let's say that, okay, to the left of us, all right, we have a person who wants to buy one share of Michael stock. I'm going to call it M stock. Okay, for $50. Okay. All right. Then we have another person here who wants to buy 10 shares of M stock. Okay, but they don't want to buy at $50. They want to buy it at 48 because they want to spend the least amount of money. And then we have another person here who he also wants to buy the stock, but he's not touching the stock of M stock unless it gets to $40. Okay. So if I brought this over here and we had to look at this over here like so, this is really, you know, what I would say is the most important start of where we need to get to when it comes to a start here. So this is the example. All right. Now on this side, the people who want to buy the stock, we can call them buyers. All right. So if I put this here and I said buyers. Now in the market, if people are trying to buy, if people want to buy and nobody's selling, what is that? That's a scarce asset. All right. The market will be locked up. Nobody is trying to buy, right? So the market order book in the market is the middleman between buyers and sellers, and is responsible for making sure that both parties get their needs met. Okay, because it's an open market, and one of the philosophies of an open market is that everyone should be able to sell something as long as it fits the rules, and everybody should be able to buy something as long as it fills ethical rules. So on the seller side, what do we have? Well, there's somebody who's willing to sell one of their shares, but they want to sell their share at $50.50. Okay. Then we have a few other people who want to sell. Okay. But what we do have is that one person wants to sell 7 of their shares, okay, at $48. And then we have another person that wants to sell 103. This person's happy with the stock, or they're not happy with the stock, and they say they want to sell, but they want to sell the rest of their stock at $44. Okay. Now the market order book's responsibility, and this is algorithmically done, needs to work out, okay, I have a few sellers on this side and I have a few buyers on this side. The buyers on this side want to buy this stock at $50.50. And I have a seller here who is close by who wants to sell. So what's going to happen? Well, what the person on the selling side would have to do, and obviously this doesn't happen exactly like that in the market order book, would either have to lower his price down to match someone who wants to buy, and they have to barter for it and then match up the price. So the seller says, okay, you know what? I can see nobody wants to be buying this stock at $50, so I'm going to wait and I'm going to take it down to $50. As soon as that happens, the middleman comes in, which is the market order book, and closes that sale. So immediately, the seller who is saying, I'll sell this for $50 will have the $50 in cash in his brokerage account. And the person who wants to buy the stock will receive the stock immediately in the brokerage account. And then this deal will be done. So we can close that out and say, okay, all done. Now, the other side of the story, and this is why support and resistance does not work. And really what we're going to look at supply and demand is areas of liquidity, which is more soundly correct, is because in this situation here, the person over here wants to have 10 shares sold. Okay. Now, Mr. Shares guy here, he has 7 of the stock of M stock for $48. Now, this person is requesting 10. So even if, he was liquidated of all of his stock and he could only manage to get you partially filled. And that's the term partial filling. Now in Forex, and pay attention to this, Forex is a very highly liquid market. So it's very rare for you to have a partial filled order, okay, for lot sizes. Even for 100 lots, 200 lots, is very, very liquid. Okay, per day, the volatility or the volume specifically for Forex is at least $6 trillion. Okay, so there's a lot of money running in. The stock market is about 10 times smaller than Forex. And you have to understand the reason why, because there's thousands or hundreds of thousands of businesses, but every country in the world has something in common. They all have currency. So by default, there's a lot more demand for currency because you need currency to acquire assets. So by default, it's a larger market. Even if it may be a more talked about market, Forex is a much larger market because it spans across so many different areas. Apart from just buying and holding onto a stock, you can take currency to exchange it to go on holiday. Okay, so the stakes are higher when it comes to Forex and therefore the liquidity. So moving forward from here, what can be done is that the market can come in and look for another person, all right, and say, okay, well, I see this guy who, in his case, he has 12 shares that he's willing to get rid of, and he's willing to get rid of them at $48.50. And this can sometimes happen. So what would happen in the real world is that you have a dollar cost average where 7 stocks for $48 and 3 for $48.50, and the last one will be filled out at a slight price or a slight medium premium, and you'll be closed out. All right. So if we were to go for what's going on here, this person who wants to get in at $48 will get a range, a dollar cost average price of the 10 stocks he's asking for. So he'll get maybe $48.10 per share altogether, or $48.20, and then he'll be closed down. Then all of his remaining stock would be cleared out. Okay, so this is how the market order book works with stocks. Now with Forex, there's a lot more price action going on, and the pip size is a lot smaller. So what happens with supply and demand, or buyers and sellers, is that when the prices move into a certain area, which is of course driven by institutional money, there'll be a lot of orders in this market order book between a specific range of prices, not a specific price itself. So the reason why support and resistance doesn't work, because there's no isolated one price point that every single person is looking at, because mathematically it's impossible for every single institutional liquidity provider to be providing the exact same price, because then that's not good business, because they'll be selling to different, interbank will be selling to, or banks will be selling to different liquidity providers at different prices, which will depend on different factors of those liquidity providers. Liquidity providers then will be selling to brokerages. Okay, so they'll be demanding their own prices. So this demand for prices in this range of people would be between a range of pips or a range of prices, not just one specific price. Otherwise, this model doesn't work for buying and selling. So the reason why supply and demand, which we're going to look at how to quantify that in a minute, is this, I wouldn't say the only thing to look at, but the way that price moves or is adhered to in the market is because price moves within a range. Okay, so within a range of price points on the level 2 data. So when we get to level 1, we just see wicks, bodies, highs and lows, but there are specific ranges of prices which are more active than others. And the reason they are is because there's a lot of demand for those prices. And then there's other places where there's a lot of people trying to sell out a certain price point. So in that range is what forms the preface for supply and demand liquidity. Okay, so moving forward from there, let's go on to the next stage and let's see what we've got going on that side. So now that you understand this example, how does supply and demand play out when it comes to the charts? Well, I'm on USD CHF, so I'm going to continue on USD CHF for these last 12 minutes. And let's take a look at what this is. Now, supply and demand is quantifiable, and I'm going to give you the logic behind why. Now, I'm going to tell you what it is first, and then give you the logic after. Supply and demand, if you want to quantify it on any time frame, is the last bearish candle and the last bullish candle of a trend. So I'm going to use 2 different colors just to give you some information about how this is. And I'm just going to put some examples here and show you, okay? But I want to write the definitions because I know some of you are taking notes. So as you're taking notes, I can write these for you to make it easier. So how do we quantify supply? So how do you quantify supply and demand on level 1 data? Okay. So to quantify demand and supply on level 1 data, let's start off with supply liquidity. Supply liquidity. Now the key here, and the reason why the term zone is used, is because a zone prefaces that the fact that there is a range of price where there's a lot more supply liquidity. Now, what is supply? Supply liquidity equals to selling liquidity, okay? The liquidity responsible to cause the price to go down or to be bearish. And I'm trying to use very simple I'll just put price to decrease, okay? All right. So remember, when people are selling, as they're selling, the price will start to drop lower, because remember, when the market order book, if someone wants to sell, okay, they may have to drop their price sometimes to kind of get those orders filled. And so that kind of bidding going all the way down is how you will see that. Okay, that's one way to put it. So selling liquidity, I missed out the I here. Let me just put this in the right place. All right, so selling liquidity. So now, when it comes to supply liquidity, we call it a supply zone because, and I'm going to put here, zone references a range of prices. Okay. So zone references a range of prices. Now, when it comes to demand, it will be the same thing. Now, when it comes to demand, supply liquidity, how do we find it? Well, it's going to be the last 1 or 2 bullish candles before a trend changes direction. Okay. Now, I hope I have enough space and it fills out. Now I'm going to put this here in another color as large as I can. Let's try and find a good color here. I'm going to use the size 12. All right. So what is supply? All right. This is a simple way to find it. Supply is the last one or two bearish candles before price changes direction. Okay. And I'll show you an example. Now, what is demand? Now, demand is the opposite. Okay. So if we go for demand now, just like we have a supply area or supply zone, we have a demand zone. Now, demand zone is the last. Now, I'll put this here. To save time, what I'll do, I'll just change this, the last one or two bullish candles before the price changes direction. Now, I've already marked some on the screen, but I want to share this first before I close out. So when it comes to the price action here, what are the driving factors that tip the price from one side to another? Now, coming back to our example here, and I'm going to drag this all the way up over here. Back to our supply and demand example, how do we know on the market order book, if we had access to it, that the market is bullish or bearish, which means the price is increasing or decreasing? Well, the way that you're going to know that is going to be by the net amount of orders. Now, do you remember yesterday we talked about liquidity? And if I bring up this example, is the amount of money per order in, order per candle. Yep. Now, every time someone is buying or selling, they come into the market with liquidity. They're either able to purchase something or they have something that they're looking to sell. So that whole bunch of things together creates liquidity. Okay. Now, the number of orders is not important per se as amount to how much is in these orders. So, for example, there's a seller here who has $44 worth per stock, but he has $113 worth. Now, if you were to do the maths on this, okay, $113, and we could do this in a moment, times 44 is approximately 4,000, let's say about 4,800, okay? And if we did the maths on that, we'll be able to work out the exact figure, okay? Now, when these buyers and sellers are coming into the market, if you were to calculate the liquidity, how would you do it? Well, it will be the amount of shares they have times the price that they're looking for to sell for or looking to buy for, okay? And the way supply and demand works in a market order book before it comes down to us, which gives us a price direction, is which side has more liquidity, because that is that side will be what drives the price. So if there's more selling liquidity, not selling amount, but then selling liquidity, if there's more selling liquidity than there is buying liquidity, then that means the price will be in supply or will be selling. So what I'm going to do, I'm going to bring up the calculator and we're going to have a look at this, okay? So if I bring up the calculator here in a moment, and we're going to take a look at where we are, then you'll be able to see what we've got going on. So I'm going to share my full screen and I'm going to bring up the calculator here so that you can see. Now, in this market, what would we look now? And some people have probably tried to do this already. Now, just as a recap, remember, these two first people, their stocks have been liquidated out properly and nicely. 3 shares came out of this. So in fact, the first two buyers have their orders met, and right now they hold on to stock. So if I drag this over here, all of that is done. So now we're left with 9 shares, okay, of M stock at $48.50. And then we have someone over here who's still trying to buy M stock for $40. Then we have someone here who's trying to sell their 113 shares of M stock at $44. So if we were to work out the money on the order book, how would we do this? Well, on this side, it's pretty easy. So if we did the calculation, it will be $40 times 100, which equals to $4,000 of buying. Now I'm going to use a term, liquidity, here. All right. So $4,000 worth of buying liquidity. I'm going to go over here to 8 and put this on that side. So this is what's on the buy side of the order book. Now, thank God there's only 2 sides of an order book, nothing more than that, because that would have become a complicated situation. All right. So Forex is not that difficult. It's either up or down. But anyway, we have buyers who have $4,000 worth of buying liquidity here. Then we have sellers, okay, who have what? So now we have to do a little bit more maths. And this is, I'm going to ask the calculator for help now. So we need 113 times 44. Okay, which is 4,972. So I'm going to write that. All right, so 113 times $44 equals to $4,972. Okay, that's for the first person. Plus, we also have, and I'll put this in brackets here. Always put things in brackets when you can, guys. So the second side of the story will be now we have 9 stocks left over on the selling side, which wants to be sold for $48.50 by the person. So if we do $48.50 times 9, so 9 times $48.50, what do we have? We have $436.50. So if I do this here, you have $436.50. If we add everything up now, so I'm going to do this here. So $436.50 plus 4,972. That equals to $5,408. So $5,408.50. Now you're probably thinking, Michael, why are you talking so much about maths? Well, this is exactly how supply and demand pressure works. So if we do the net total, you can see already that in terms of selling liquidity, and I'll just put this underneath here. Let's change this out for this area here, selling liquidity. Let's have a look. So you see we have $4,000 of buying liquidity and $5,480, dollars of buying liquidity and $5,408.50 of selling liquidity. So in terms of who has more, and this is a new word I'm going to introduce now, selling pressure, there's more pressure for selling than there is for buying. There is selling pressure in the market. Why? Because if we were to do a net total of who has more money in the market, now the key here is that whoever has money, more money in the market drives the direction. And I think what I'm going to put here is this sentence so that you can remember. Whoever has the most liquidity in the market order book, okay, drives the price direction. Okay. So whoever has the most money in the market order book drives the price direction. So what in this case, right now, the sellers have it because they have more liquidity in the market, okay, than the buyers. Now, the key thing is that this market order book is hidden. Number two, it's actually manipulated and controlled by these group of people. So they always have the liquidity to put the price. They can put the price and make it bullish, or they can make it bearish, okay? And this is the key to understand what's going on. Another thing is that they have access to the price a lot faster than we do. So now the question is, how do we know when the big fish are moving so that we can jump in with them? And if you frame your mind in that way, instead of believing that price is controlled by what a free group of traders do, retail traders do, it will save you a lot of heartache. So now that we know that this is selling liquidity, then the price should be bearish. All right. Now, for us to find this whole infrastructure in a very simple way with candlesticks, this is how we work out what supply and demand is. So if I go back to our example now, so if I come back to this example, how do we find this? Well, because the price is on a tipping point where liquidity is being controlled by the sellers at the moment, in this case, or supply zone, we need to find the price range. And this is the key, remember this, we need to find the price range that is controlling or where selling is most likely going to happen, okay? And in this case, for example, in my example I've made, $44 to $48.50 would be the price range where selling pressure will be at its highest because we have a lot of orders within this range. All right. Now, if it came to buying, if someone was looking to buy, where would most of the buying pressure be? Well, it's quite simple. Everybody else in this situation, in this example, has already had their stocks liquidated. The only person really waiting on this example market order book is our friend down here at $40. So what do you think will happen when the price gets down to $40? Then he's going to be hunting for an entry to buy M stock. So that means the supply range would be between $44 to $48.50, and the buy range would be at $40 or at a range around $40. Okay, realistically speaking. So what would that mean? So as a trader, if you saw the price get into $44 to $48.50 range and the price is hanging around there, your next trade would be a sell. and your target would be at $40 because, as soon as the price goes down there, it's going to bounce back up. And this is exactly how liquidity engines work. So now we've looked at that liquidity engine. How do I identify this? I'm going to do a few examples, and I'm going to give you guys homework. I'm hoping to see some posts from you to try to do the same thing. So if we start off here, let's go over to USD CHF. Now, supply zones will be the last two candles before the price changes direction. Why? Well, whatever liquidity or price range that caused the price to, in this case, we can see the price pushed upwards and now has gone down. And to put this into perspective, even the chart looks pretty tiny, from the end of November 2022 until where we are now in May, this was the supply zone that caused it primarily. This area would be called a supply zone. Now, there is a difference between when you use the last two or the last one candle. And I want to put a little preface here, okay? So marking zones, I'm going to call it. So when you're marking zones, one of the things I would say is that when you're choosing whether to choose to use the last two or the last one candle, bullish or bearish, you need to make a few assumptions. It's going to be the last two if one candle has a small, I'll say a small body and large wick. Now I'm going to put an S in brackets because it could be wicks. All right. So I'll give an example of that in a moment. So when marking zones, if it's going to be the last two, is if one of the candles, and I need to make sure. So if one of the candles, and we're talking about candlesticks here, has a small body and a large wick, or smaller body and larger wicks, then what you'd want to do in this situation is to make sure that you go for using two candles. In the situation of one candle, is if the last candle has a large body. So for last one, if you're going to use one candle, is if the candle itself we're talking about has a larger body and smaller wicks. Okay. And the reason why is because the liquidity is in the body of the candle. Okay. To measure how much liquidity there is per candle, you can actually do a small arbitrary calculation to work out approximately how much there is. For the price to move by 1 pip, it costs around about $50 million for that to happen. So if a candle body has 30 pips on it, then you can do 30 times $50 as an average price action or price calculation. So larger body, all right, than wicks. So if you do a larger body than the wicks here, okay, then that will put you in a position where you actually have the last one. So let's do some demonstrations. I'm going to stay on the D1 chart. Now, if we look over here, if you look at what price did, so if we follow along, we can see the price was pushing up for a bullish movement. When it got here, for whatever reason, the price decided to sell off again. And then it came back into the same area one more time. And then from there, you can see the price has dropped down consistently for a very long time. Now, so one thing about supply zones is that it's going to be at the end of every major change in price. If we were to back test this and look a bit further back, you can see over here, we have a supply zone over here. Here's one. You can see the price was pushing up for a bullish movement. And then once it got here, we can see this very strong drop, the price changed direction. So this would be a strong area of price. Now, the key is, how do we use these? Well, let's look at a little bit more, and then I'll go through how we use these. So here's another supply zone. If you notice over here, here's a good example. So price was pushing up for a very strong move. Okay, over here. Dropped down, came back into the same area, and look at what happened. Price sold off very strongly again. Okay. After that, we see the price pushing up again. Now, here's an example of where you would use two candles. If you notice, for the first one, I just used this candle because we can see we have large body, small wicks. In this case, we have large wick. Now, it might not be so easy to see until I zoom in. And if I zoom in here and just take this back a little bit over here, look at this candle here. If I isolate this candle with the color very quickly, you can see this candle in question here in the red. You can see that the body is very small compared to the wicks. We have very large wicks and small bodies. Okay, so you'll say, okay, Mike, the pattern you've shown me doesn't work because this candle went up only here. It didn't go here and sell off. Well, I'm going to show you. And this is one of the ways where you need to understand graphical data from this point of view. So when you notice that, if I was to just do something here, now, whenever you hover over the same color in MetaTrader 4 for whatever reason, it kind of makes the area white. It kind of zeroes out the area. So what I'm going to do, just for the sake of this teaching, I want to make this a much deeper color. So I'm going to try for, let's go for like a sky blue. All right. Now, if you notice here, if I take the last two candles before the price changed direction, so 1, 2, notice what happens. When the price comes here, we have this little touch into this zone at the second candle, and then bam, sell off again. You see that? So when it comes to looking at supply and demand, this is a key thing for you to look at. All right. So I hope that you guys will make sure that you take this into consideration for supply. Now let's move on to demand. So we can start from the same places. If I go back a bit, let's take this further back. Now, talking about the liquidity that caused the price to get up to this area, let's look at demand. So over here, look, what caused the price to go from this area to this area? We have two demand zones. In fact, we have one here, and I'm going to take the last two candles because, again, this is almost kind of a 50-50 showdown. The body and the wick is almost the same length. So in this case, just for the sake of being safe, I would use both candles. If you see what we had here, price came into this area here, and then bam, the price moved up for a long. Okay. If we take it back a bit further, all right, we have a small demand zone over here. All right. Price went into this area just about slightly and took off very strongly. Go back a bit further, and this is another example where you use two candles. If I just zoom in here and take this back a little bit, notice over here, the price went very strongly long over here. Now, the last bearish candles before the price changes direction is this candle here. Over here, we have a candle which has two wicks and basically no body, which is called a doji candle. So in a situation like this, what you would do, now I don't trade dojis because candlesticks patterns was something I tried for a long time and it didn't work because institutional money wasn't a factor in understanding how the market works and the manipulation that price actually does. So in this case, if you took both candles, all right, ignoring this to be a doji, but just as a candle with basically no body to it, price pushed up, it came back in here, and then you can see over here we had a massive rally. So this is how you quantify price. Now, what are we doing when we're doing this? What we're mapping out is exactly what I just spoke about in this elongated example. Now, when it comes to the price ranges of where selling and buying most likely will happen, we're using the candlesticks to quantify level 2 data. So you can put yourself a pat on the back. You're reading the market order book without having to see the market order book. And this is why supply and demand is an engine of price. Now, for this episode, I'm going to end it here. And we're going to go in tomorrow to find out what do we do when the price is in here? What do we look for to know the moment where we should pull the trigger? So I hope you guys enjoyed that episode of this series. If you have any comments or questions about it, let me know. And I'll catch you guys